Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look at valuations in the S&P 500, but then we also look outside of the S&P 500 at other sectors, other indexes, other markets, because sometimes we can get some insight as to what's happening in the S&P by looking across the whole spectrum of the different markets and just see if we're getting any insight from that. This is being prepared for Monday, March 4th. The first area is S&P 500 valuation, and we look at what's already happened, so the historical basis, and then we look forward as well. This is a chart looking back. This is called the trailing 12 months, and these are earnings reports that have already been released, and the market's had a chance to digest them, and we can measure them on a thing called a PE ratio, a price to earnings ratio. The higher this number is, the more the market has a tendency to go up. When these numbers are going down, the market tends to go down. Well, what we can do is we put these on static levels. We have a PE ratio of 10, 15, and 20. When the market is above 20, that's when it's considered to be expensive. And right now, the black line, that's the S&P 500, and it's getting kind of far away from the PE ratio of 20. So on a historical basis, the market continues to be expensive. But it's been expensive now for quite some time. We don't necessarily use this to make decisions. It's just to give us an overall idea of the condition of the market. We can also plot this according to different events that have happened, going back to 1980, and then what the valuations were at that time. Another way of looking at this is looking at it over a period of time, a smoothed effect. This was developed by Robert Shiller. He came up with the Shiller PE ratio. You also may know this as CAPE, C-A-P-E. The reading that he's getting right now is 34.58. Well, to give us some context, we can look at the chart to see historically what has happened. And then we can also look at the median and the mean up above, where we're currently between 16 and 17. We're coming in at 34.58. So this is also suggesting on a historical basis that the market is expensive. But the market doesn't do that. It looks forward. Uses a thing called the forward PE ratio. And on this chart, you see a number of different indexes. The one that we really follow is the S&P 500, which is the red line. And we're currently coming in at 20.6. So we're just a little bit overlooking kind of expensive when we look at that 10, 15, or 20 scale. Just to get some perspective, we also have the mid caps and the small caps, and then there's some different annotations here of what the market conditions were like. Another area that we look at is growth versus value. When growth is doing well, the market really has a tendency to perform better. When value is doing well, that typically means that the market is under some pressure, if not actually in a decline. The first thing that we look at here is the Peer Growth Index, all by itself. And this is in an uptrend right now and looking pretty solid, but it still has a ways to go to get back to the 2021 highs. Then we look at a Peer Value Index, which has also been doing quite well. So they're both in uptrends. Where it becomes interesting is when we do ratios between them. And we look at growth versus value on the top. And when this is going up, that means the growth is outperforming. On the bottom, this is an inverse of that same chart showing how value has been underperforming. And the reason why I use a lot of different charts and indexes and longer charts and shorter charts, because we want to see conformity across all of the different charts that we look at. You can see there's a little bit of an offset in time when these moving averages crossed. We want to make sure that we're seeing the same thing at the same time. Here's an ETF of growth to value showing that growth is outperforming value. This is an inverse showing how value is underperforming growth. And here's another look, longer term, showing how growth is outperforming value. And we're seeing a golden cross here where growth is outperforming value in a more of a trending sense as well. Then we look here at value. This is a shorter term chart where it is underperforming growth. Then here's another look showing how growth is outperforming value. So it might seem like overkill, but looking at all of these different charts, we want to just see a lot of confirmation here. We also look at another way of measuring growth of value. These are a couple of ETFs, and this is showing that growth is outperforming value, but not back to the all-time highs. Here's an inverse showing how value is underperforming growth. Then we want to break it down and we look at an end of day chart and we look at the small caps, mid caps, and S&P. We've been seeing a lot of improvement here with the small caps. Now, we're just coming off a week where the small caps were up 3%, and everybody's like, "Oh, is it time to jump into small caps?" And I'll try to answer that as we go through this video, but we are seeing some improvement here. We had been chopping sideways for about a year. Now we're starting to break out. We're not really breaking out with any strength currently, but this is showing some improvement, even though we're not seeing an awful lot of movement in the index itself. It was up on the week, but we still have these highs that were set back in December that we haven't been able to get above. Now, this is just looking at the small cap. This is the S&P 500 small cap index. We also look at mid caps, which are looking a little bit stronger. We're seeing growth outperforming, and we're seeing a little bit more of a breakout when we look at the index itself. This is showing S&P 500 growth to value, and we finally were able to get above this previous high, and this is showing some improvement as well. So growth seems to be holding up for the time being. We also keep an eye on inflation. On top, we have a monthly chart of the CRB index. That's commodities, and it's pretty much been chopping sideways lately. And then on the bottom, we have a monthly ratio between inflation and deflation. When this is going down, that means that inflation is going down. When this is going up, that means deflation is actually going up as well. And so we're seeing where inflation is really dropping off currently. Here's a daily chart of the CRB index with the different measurements inside of this particular index. And we're still in a downtrend, even though we've been bouncing back up lately. This is the Baltic Dry Index. What does it cost to ship products from one place to another, specifically in the Baltics? This has been starting to go back up. So that could put a little bit of pressure on shipping prices. Some other markets, we look at aluminum, which is just about ready to give us a golden cross here, but we're still in a downtrend longer term. Corn continues to be in a downtrend. Wheat is in a downtrend. Fertilizer been chopping around a little bit. Oil, it's been getting back up close to that 80 range. It's been really choppy lately. When the Russia-Ukraine war first broke out, we saw a real spike up in oil, and then it fell back. This other spike, that was when things started to escalate in Israel. Then it's been falling back. So we're wondering, is this going to keep going up, or are we going to more or less chop sideways? Here's gas, which has been going up, but is still in a downtrend. Here's diesel, which is starting to go back up, but it's also in a longer-term downtrend. Heating oil going back up just a little bit, but still in a downtrend. Natural gas has really been going down lately, and it's in a much more solid downtrend. Copper is still having a tendency to be positive, but chopping sideways. Typically, when the economy is looking better, copper will go up. When there's economic weakness looking forward, copper will go down. So what we do is we do a ratio between copper and gold, where a week ago, copper was really outperforming gold. Now, as this is falling down, that means copper's underperforming gold. We look at this on a longer term chart. The black line is the copper to gold ratio. And then we plot the 10-year yield and the 2-year yield, and we're still far away. And typically, they'll have a tendency to move in the same general direction and not get that far apart. We're still seeing a really wide spread. And even though this ratio is just not really moving all that much, lately we've been seeing interest rates starting to go back up, even though in this past week they did decline. Here's gold, which is still having a difficult time really breaking out, but it's in a longer term uptrend. And this is just looking at the gold ETF. Silver continues to be in a downtrend, which is kind of strange. You would think gold and silver would be more in tandem with each other, but silver hasn't been performing all that well lately. So what we do is we look at an end of day chart for the price of gold and the end of day chart for silver. You can see where gold is holding up a lot better here, where silver still has a ways to go to get back to these previous highs. What I look at on the bottom is the correlation between the two, and it's showing that it's neutral right now, where most of the time we see the correlation pretty strong. The higher the reading, the more gold and silver are going in the same direction at the same time. Then we look at the gold to silver ratio on top, and sometimes we can get some insight by comparing it with the US dollar index in the middle. Well, right now, that relationship isn't very strong. The dollar has been rebounding since the beginning of 2024. It's still in a longer term downtrend, But if we stay above these lines, we eventually may see a golden cross here. We look at the euro up on top and compare it with the US dollar index, and I have a breakout chart here. We also keep an eye on the Japanese yen, and I have a chart for that. The euro is still in an uptrend when compared to the dollar, but it's really been chopping sideways lately. The Japanese yen is in a downtrend when compared to the US dollar. The British pound also more or less going sideways, but still in an uptrend compared to the US dollar. Some index ratios, and I show this in every daily video, where the equal weight index is starting to show some improvement here above the S&P 500 weighted index. Here's another measurement. When this is starting to go back up, that means that the equal weight is performing better. It's been really underperforming as we have a large part of the gains being attributed to the Magnificent Seven. Now, there's other stocks than that are helping the market to go higher that I'll show you later. But those stocks are so big and they have such an impact on the indexes. When they're having an up or down day, they can impact the S&P 500 as well as the NASDAQ 100. Then we look at a ratio between stocks and commodities, showing that stocks are outperforming. This is an inverse showing how commodities are underperforming. The NASDAQ 100, which is close and setting new all-time highs. The S&P 500, which is setting all-time highs. This is showing that the NASDAQ 100 is even doing better. Now, you might think, why not get into the NASDAQ 100? And right now, that would be a good thing. But when we ran into some problems in 2022, it was the NASDAQ 100 that was going down faster than the S&P 500. So not only can it outperform when we're doing good, it can also outperform when we're doing bad. Here's the S&P 100, which are the biggest stocks in the S&P 500, showing how that the bigger stocks are outperforming. This is the NASDAQ, which just set a new all-time high this past week, and the S&P 500, showing that the NASDAQ is actually performing better. And both the NASDAQ 100 and the NASDAQ are doing well, but the NASDAQ 100 is doing even better. Here's the mega cap growth, the really big companies, and compared with the equal weight index, showing how the mega caps are outperforming. And then we want to keep an eye on small caps. And this is, since we had a real solid week with small caps, a lot of the buzz is, should we really jump into them? Well, we're not really seeing much of an improvement here with our small cap to S&P 500 ratio. We want to see this really break out. When this really moved up at the end of 2023, that was looking more solid, but then we fell back once we hit the new year. Now, small caps may come into favor more and show some improvement, but we're just not seeing an awful lot of that yet. This is where we look at a ratio where the small caps are continuing to underperform the S&P. The S&P is doing well and small caps had a good week, but this ratio has been continuing to decline. So we want to compare them with other markets. The 30 biggest software companies are not really breaking out. They have a ways to go to get back to their all-time high, but they are in an uptrend. Here's the mega caps, which just continue to go up and up and up and are in a very solid uptrend. Here's the robotics and AI ETF. This is what the rage is all about these days, and it's looking pretty good. We're above all the lines here in the rainbow. We're moving out. We're not back to the all-time high yet, but we are showing some improvement. And we are showing some improvement when we compare it to the tech sector. This had actually been underperforming. It still has a ways to go to look better, but it is showing some improvement. Here's the Dow Jones Composite Average, which is the Dow, the transports, and the utilities. And the transports are quite weak, and I'll show you that. The utilities are in a downtrend. So most of the strength that we're getting right now is coming from the Dow, and that's showing that this is in an overall uptrend and just coming off of setting all-time highs. Here's the S&P 500 compared with shorter-term bonds from 1 to 3 years. This is suggesting on a shorter-term basis that stocks are outperforming. Then we look at the S&P 1500, which is a broad market measure, and also compare it with shorter-term bonds. And this is suggesting there's more participation across the market as stocks are outperforming the shorter-term bonds. And we look at another broad market measure, and we go further out with bonds. This is also suggesting that the broad market continues to outperform. And then this is a newer ETF that I just started showing. It's called the Total US Stock ETF, and it's a weighted index, or weighted ETF, I should say. But it has 2,651 stocks. And if there's only 7 stocks that are making up all of the gains in the market right now, this wouldn't be setting new all-time highs like it is right now. And the big stocks, they're included in this ETF as well. So this is showing that there is some broad market participation. And we look at the low volatility ETF, which is continuing to be in an uptrend when you look at it by itself, but it's just going down, down, down when you compare it to the S&P 500. Then we look at the tech sector, which is really doing well when compared to bonds. And then we look at some advanced decline line studies. And I show this in the daily videos as well. We're starting to break out a little bit here with the NYSE based on common stock. That's a broad market participation. We're breaking out with the S&P. We're showing a lot of improvement with the mid caps. We're lagging, but showing some improvement here with the small caps. And then this is traditional Dow theory, where we're really close to all-time highs with the Dow, but the transports are just languishing at best, going sideways, and the utilities are in a pretty solid downtrend. This is just looking at the transports, where they haven't even come back to these previous highs we set at the end of 2023, let alone another high that we set back in 2023 and the all-time high back in 2021. It would be a lot more positive for the market if the transports could really go up. And I've been saying that over and over now. The market's still continuing to go up, but the transports are not participating. So this is one of the warning signs that we want to be aware of. And then this is a ratio between the transports and the S&P 500. And this is really going down, showing how the transports are underperforming as the S&P has really been going higher. This is a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, and that's pretty much what's been happening. And then here's the correlation between the S&P on top and the transports, showing that they have a fairly strong correlated relationship. So if the S&P is going up, you would think the transports would be going up, but they're not really outperforming with any real conviction right now. Then here's a new look at Dow theory, and then I have another variation of that after this. We look at the S&P 500 on top. That you could make a case for the S&P 500 being a better representation of the U.S. economy. And it's going out and setting new all-time highs. And instead of using the transports, which is when Charles Dow first created this, railroad stocks were the big stocks at that time. Well, now we're more of a technology-based society. And so instead of using the transports, we use the NASDAQ, which did set new all-time highs this past week. So on this level, we are confirming each other. We're setting new all-time highs with the S&P and now with the NASDAQ. Now, to break this down a little bit differently, this is an equal weight S&P 500. So all stocks are treated the same. It is coming and setting all-time highs as well. And then instead of using the NASDAQ, we use an equal weight ETF for the QQQs, which is the NASDAQ 100. And this is also setting all-time highs. So we're seeing confirmation this way. The FANG index is really close to setting all-time highs and is still in an uptrend. This is Facebook, Amazon, Apple, Netflix, Google, and some other ones. And then I keep this chart handy just in case we start to decline. We'll be looking for different areas of support. But right now, we're not declining, so I haven't been paying much attention to this. ARC, it was doing okay. It's still in an uptrend, but it's really been chopping more or less sideways as the broader market has really been doing better. And then this is a monthly chart of a ratio between the S&P 500 and then international stocks that are in Europe, Australia, Asia, and the Far East. When this is going up, that means the S&P is outperforming. The red line is going up and we're above the red line. This is showing how the US stocks are outperforming global stocks. We can also put a momentum oscillator on here as well, and that is continuing to show that things are positive. And this is a long-term chart. It's a monthly chart. Then we look at the price of bonds, which continue to be in an uptrend, even though they've been falling back. These are world bonds, also in an uptrend, but they've been falling back. Stocks continue to outperform bonds on a monthly chart. This is a daily chart showing how bonds are underperforming stocks. And then these are junk bonds showing how we're not hitting all-time highs yet, but we are showing some real improvement here. And these are investment grade bonds, more conservative, still in an uptrend, even though they've been pulling back. Then here's a ratio between the riskier bonds, junk bonds, and more conservative bonds. It's coming down a little bit because folks are getting a little bit more confident that maybe the Fed is done raising rates. And that's when they'll get out of the riskier junk bonds and they'll try to lock in the longer term government bonds, which are much safer. And we started to see that a couple of times when we came down. And then when some economic reports come out that are stronger than expected, or the Fed comes out and says, we're not going to lower interest rates. And they sound exactly like that, by the way. Then we start to see this ratio going up. Well, as things have been improving lately, this ratio has been coming down. Then we look at a correlation between stocks and bonds. They're having a pretty strong tendency to go in the same direction. If they're both going, they could be both going up or both going down. Then here's the Dow Jones Corporate Bond Index, which is in an uptrend, but it's been chopping sideways lately. Here's a Fibonacci measurement on the 10-year yield. We hit that 5% back in October, and we've been coming down. And then this was putting some pressure on stocks for a while anyway. And there was a time just a couple weeks ago where interest rates and stocks were going up at the same time. But now we're seeing interest rates coming down slightly with the 10-year. This is a longer term look, wondering, are we heading into a new type of environment where instead of seeing this long-term decline in interest rates, now we're starting to go back up? Is this creating a new environment for the market as far as interest rates are concerned? I've been showing this for a while. This is when we hit the 5% level with the 10-year yield. And then we bounced off of that, and everybody was happy at that time. They thought, oh, we're going to have a soft landing. That means no recession. The Fed is going to start cutting interest rates. Okay, that was something positive. Now, this scenario has been modified a bunch since then. But the other times when we had really low readings with this ratio, this is when there was the Euro crisis, and then this is when we had the COVID plunge. You have two negative events here, and then this is positive. And so we're seeing a little bit of a contradiction here. And even though this chart is a bit out of date right now, we still want to keep an eye on that. And here's a Fibonacci measurement of the 30-year yield, where we're not really hitting any of these retracement levels yet. Here's a ratio between the S&P 500 and the 10-year yield, showing how the S&P 500 is outperforming. And then this is 3 to 7 year bonds and comparing them with stocks. This is showing how bonds are underperforming. To say that another way, stocks are outperforming. Junk bonds, not really hitting new all-time highs yet, but still in a really solid uptrend. And then we do a ratio between junk bonds and then more conservative bonds, showing how junk bonds are outperforming. And as this is gyrating around, that's what we would expect to see. If interest rates have finally topped out and are going to start to come down, we would tend to see this ratio coming down as well. And then this is just an ETF of the 7 to 10 year bonds, where we came down to the 200-day moving average, and we're starting to go back up based on price. We're crossing above 50 with the RSI. We're starting to cross back over positive with our momentum. Here's a daily chart of the different maturities for yields where we had been going up. Lately, we've been starting to come back down with our interest rates. Here's a weekly chart looking internationally, where we saw a slight decline with the US and UK rates this past week. German rates are still starting to go up, and we're lower, but pretty much flat with the Japanese rates. The MOVE index measures the volatility of bonds. The VIX measures the volatility of stocks. They have a fairly strong correlated relationship. The higher this reading, the more solid their relationship is, and it has been showing a little bit of strength there. There's a monthly chart of the price of the 30-year bond, which continues to be in a downtrend and underneath the declining moving average. On the bottom, we compare bonds with commodities, showing that bonds are still continuing to outperform. This can take a long time. This is a monthly chart, so these things don't shift really quickly. Looking at the different sectors, the materials sector still underperforming the S&P. Communication is one of the stronger sectors in the S&P, and it's outperforming. Energy is continuing to underperform the S&P. The financials, and we want to keep an eye on this. We're still hearing that news from New York Community Bank. That's what you see the downward move here in Friday's session. The S&P went up, but the financial sector went down. We've been chopping more or less sideways. Things were starting to look more positive here, but then we got that news, and we've been kind of having a little bit of difficulty lately. Industrials, which had a pretty good week, they're still in a longer-term downtrend, but they have been showing some improvement. The tech sector, another strong area, continues to outperform the S&P. Staples are underperforming the S&P. Real estate's really underperforming. We saw this nice little bounce when we it appeared to have topped out with the 10-year yield in October. Interest rates were coming down. That was good for real estate. Then when interest rates started to go back up, real estate started to go back down. Utilities are still really in a downtrend and underperforming the S&P. This is a ratio that we look at. When the S&P to utilities ratio is going up, that tends to be very supportive for the S&P 500. Healthcare is also in a downtrend and underperforming. Here's another chart showing that it's just not faring all that well right now. Discretionary, we wish this was doing better. This would help the market do better. It's showing some improvement, but it's still continuing to underperform the S&P. Staple sector, and this tends to not do as well when the economy is doing better, because these are things that you have to have. It's discretionary when people are making more money and they can go out and buy fun things, but we are in a pretty solid uptrend with the staple sector. The tech sector is really probably about the best performing sector right now. Semiconductors are also doing very well. And we do a ratio showing how the tech sector is outperforming the S&P. Energy is underperforming the tech sector. Energy did really well in 2022. It's been underperforming since the earlier part of 2023. And then this is growth stocks compared with the price of bonds, showing how growth stocks are outperforming. This is the tech sector compared to the 10-year yield, showing how the tech sector is outperforming. This is an inverse showing how interest rates are underperforming. Discretionary to staples shows that discretionary is outperforming. We just want to see it doing better than what it's been doing. And this shows how staples have been underperforming discretionary. Gold, which is doing okay, but it's still really continuing to underperform the S&P. It's bouncing back up as we saw the dollar go down just a little bit this past week, but overall it's been underperforming the dollar. High leverage loans, these are very risky, and they're continuing to set new high after new high with this. Here's the NYSE composite, also setting all-time highs and in a solid uptrend. All stocks looking in the US as well as internationally, setting all-time highs. Emerging markets still having more of a tendency to chop sideways, but they are in an uptrend. The Japanese Nikkei, it did come back and set a new high when you look back to 1989. Yeah, something to be said for patience there, huh? Yes, it's fun. It took a long time, but we're finally starting to see a bit of a breakout with Japanese stocks. These are the small cap, or really small stocks, the micro caps, and they're still having a tendency to do well, and they are in an uptrend. We look at the home builders ETF, and we're not really seeing anything here, so I won't take the time to go through this. We look for divergences here, but we're just not seeing that right now. Bitcoin, not back to its all-time high yet, but it has been really doing well ever since those ETFs were launched. And you probably have a lot of big institutions that are having to buy Bitcoin in order to fund those ETFs. And of course, the anti-Bitcoin folks are just, yeah, it's going to crash, it's going to go down to 10,000, it's going to go to zero. Well, follow the charts. That's all I can say. And then looking internationally, China is now in an uptrend. Emerging markets are in an uptrend. We're seeing Europe start to turn back up. Japan's turning up. And we're actually doing better than this, but you're not really seeing it with the KST here. The S&P 500 is also in an uptrend. Here's the InterMarket Analysis chart showing how since the beginning of the year, oil has been doing the best, followed by stocks, the dollar. Gold has finally turned positive, seeing some improvement with bonds, but still negative. Looking at some correlations. First, we look at the S&P 500 to the dollar. They're having a slight tendency to go in opposite directions of each other. Here's the S&P 500 to oil, where they're having a slight tendency to go in the same direction. The S&P 500 to the 10-year yield, they're having a tendency to go in opposite directions. Tech sector to the 10-year yield, also opposite directions. And then the S&P 500 to the 2-year yield, that's neutral right now. And then some long-term measurements. This is a monthly chart of the NYSE composite, and we're above the moving average and going up. So longer term, the uptrend is still intact. We can measure that with another momentum oscillator, the Kopic curve, and that is also in an uptrend. Then we look at a daily chart, and this is continuing to go up with the record high percent index. So we're looking good longer term on the monthly chart. We're looking positive on the daily chart. Here's the S&P 500, also above the moving average. This is a monthly chart, And the PPO, another momentum oscillator, is continuing to go up. So longer term, we're looking positive there. Then we have the S&P on top, and then a ratio between stocks and the CRB index showing how stocks are outperforming. And then this is another global measure comparing the S&P 500 on a monthly chart with global stocks showing how the S&P is outperforming. We're right on top of the moving average with the KST, but this is potentially showing some signs of improvement. Then at the end, what I do is I list all those things that are positive. And my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. So we have the growth indexes as well as value indexes. When you look at them independently, they are in uptrends. Copper, it's fighting to be in an uptrend. The British pound and the euro compared to the US dollar. Gold is in an uptrend. The big software companies, the mega caps, the FANG index, ARK, the low volatility ETF, staples, the Dow Jones Composite Average, all the different bonds that we look at are in uptrends when you look at them based on price. The tech sector, as well as semiconductors, high leverage loans, the Dow, the NYSE Composite, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. So all of the main stock indexes, they are in uptrends. But the mid caps, small caps, and micro caps, they've got a long ways to go to set new all-time highs. All stocks looking both in the US and internationally are in an uptrend, emerging markets, and Bitcoin is in an uptrend. Then I look at the things that are negative. This is when the 50-period simple moving average is below the 200-period simple moving average. The dollar, even though it's been improving since the beginning of the year, it hasn't gone into an uptrend yet. The CRB index is still in a downtrend. Silver's in a downtrend, even though it's showing some signs of improving. And the Japanese yen when compared to the US dollar. Thank you. I really hope you found this helpful. Please feel free to check out the daily video and weekly video that I just posted. I hope you have a really great weekend, and I will talk to you in the next video.